There's something you've been feeling for years. Something that's bothered you every April, every tax season, every time you looked at your pay stub and saw how much had been taken out before the money even reached you. You know something is wrong. You can feel it. You work hard. You pay your taxes. And somehow, people with 10 times your income, sometimes 100 times your income, are paying a lower percentage of their money in taxes than you are. It's not your imagination. It's not paranoia. It's not even controversial among the people who actually understand the tax code. It's real, it's documented, and it's almost entirely legal. Let me show you the blueprint. Because the tax code in America is not one system, it's two. There's a tax code for people who earn a paycheck, and there's a tax code for people who own assets. And the gap between those two codes is where the wealthy have been quietly building their fortunes for decades, while the rest of the country wondered why the math never seemed to add up. Let me explain what I mean by two tax codes, because this is the foundation of everything that follows, and once you see it clearly, the entire American financial landscape starts to make sense in a way it never did before. The first tax code, the one you probably live under, is called the Earned Income Tax Code. This is the tax code for people who trade time for money: doctors, teachers, engineers, nurses, police officers, truck drivers, small business owners, anyone who shows up to a job, does work, and gets paid for that work. Under this tax code, your income gets taxed at what are called ordinary income tax rates. And in 2026, those rates climb quickly. If you earn between roughly $48,000 and $103,000, you're paying 22% federal income tax on the money above the lower bracket. Above that, you hit 24%. Above $197,000, you're at 32%. Above $250,000, 35%. And at the top, above $600,000, you're at 37%. But that's just federal. Add state income tax on top, which can be anywhere from 0 to over 13% depending on where you live. Add Social Security tax, which takes another 6.2% up to a certain limit. Add Medicare tax, which takes another 1.45% with no limit. By the time a middle-class professional finishes paying federal, state, and payroll taxes, they can easily be handing 35 to 45% of their money to the government every year for 40 years. Now, here's the second tax code, the one almost nobody explains to working Americans. It's the tax code for capital, for investments, for assets, for money that money makes, rather than money that your body or brain made. Under this second tax code, the rules are dramatically different. If you buy a stock, hold it for more than a year, and sell it for a profit, that profit gets taxed at what's called the long-term capital gains rate. And the long-term capital gains rate for most Americans is either 0%, 15%, or 20%. Let me say that again, 0, 15, or 20, not 35, not 45. A single person can earn up to approximately $47,000 of long-term capital gains every year and pay 0 federal income tax on that money. 0. A married couple can earn up to about $94,000 in long-term capital gains and pay 0. Now let that sit for a moment, because the implication is staggering. A couple living on $90,000 a year of investment income from stocks they bought 20 years ago, from dividends from rental properties, can pay less in federal taxes than a teacher earning $50,000 a year from a job. This is where most people get it wrong. They think the wealthy have some secret loophole, some hidden trick their accountants know, some tax shelter in the Cayman Islands. And those things exist for some of the ultra-wealthy, yes. But the real gap, the gap that affects the average working American, has nothing to do with loopholes. It's right there in the main body of the tax code, written in plain language, available to anyone who understands the difference between earning income and owning assets. The tax code, in plain English, is telling you something. It's telling you that wages are punished, investments are rewarded. The more your money comes from labor, the higher your rate. The more your money comes from capital, the lower your rate. And this difference isn't a mistake. It's not an oversight. It was built this way on purpose, for reasons lawmakers will debate forever. But the reasons don't matter to you tonight. What matters is that the rules exist, and the rules can be used by anyone willing to learn them. You don't need more money. You need a better plan. And the plan starts with accepting a hard truth. If you earn your living from a paycheck, you are operating under the heavier tax code. Every year, that code takes a significant piece of what you produce. And no amount of working harder, no amount of earning more, no amount of side hustles will change that fundamental fact. A high-earning professional on a W-2 in America will always pay dramatically higher taxes as a percentage than a moderately wealthy retiree living off dividends and long-term capital gains. The only way to change which tax code you live under is to slowly, patiently, deliberately start building income from assets alongside the income you earn from labor. And the decade when that shift becomes possible, when an ordinary professional in their 40s can start quietly transitioning toward the investor's tax code, is right now. The next 20 years of your financial life. But before we get to how, you need to understand one more layer. Because there's a third category of wealth that pays even less tax than capital gains. And it's the category where the truly wealthy live almost permanently. The third category is borrowed money, and this one, when you understand it, feels almost surreal the first time you see it. Because borrowed money, under the American tax code, is not taxed at all. Not a dollar, not a cent, ever. Let me explain what I mean. When someone takes out a loan, a mortgage, a business loan, a line of credit against their investment portfolio, the money they receive from that loan is not considered income. It's debt. Debt has to be paid back someday, so the tax code treats it as if no economic event has occurred. You borrowed $1 million? That's $1 million you now owe. Zero tax, zero reporting, zero impact on your tax return. Now, imagine you are extraordinarily wealthy. Imagine you own $50 million in stocks and real estate. You want to buy a house. You want to take a vacation. You want to fund a business venture. What do? If you sell $5 million of stock, you pay capital gains tax on the profit. That could easily be $700,000, $1 million of tax on a single transaction. A painful bite. But if you call your bank instead, they will happily lend you $5 million against your stock portfolio as collateral at relatively low interest rates because you're a very safe borrower. The money hits your account, you spend it on whatever you want, and the IRS has no involvement. No taxable event occurred. You didn't sell anything. You borrowed against something. The interest on that loan, you pay it over time out of the ongoing income your investments generate. Dividends, rental payments, bond interest, which gets taxed at the lower capital income rates we talked about a moment ago. And because the stock market historically grows faster than the interest rate on these kinds of asset-backed loans, the underlying stocks actually grow more than enough to cover the debt. Your wealth keeps compounding untouched. The debt gets serviced out of the dividends, and you live your life entirely on borrowed money that never gets taxed. This strategy has a name in wealth management circles. It's called buy, borrow, die. You buy appreciating assets. You borrow against them for spending. And when you eventually die, something remarkable happens under American tax law. Your heirs receive those assets at what's called a stepped-up cost basis, which means all the decades of appreciation that happened during your lifetime get wiped out, tax-wise, at the moment of your death. Your heirs can then sell the assets and pay almost no tax because the new cost basis resets to the value at the moment they inherited them. In plain language, the wealthiest families in America can grow wealth across generations, spend freely along the way, and pay remarkably little tax at any point in the process. Not through loopholes, through the intentional design of 3 separate sections of the tax code working together. This is where most people get it wrong. They hear about the wealthy paying low tax rates and assume something sinister is happening. Some secret, some cheating, some privileged access to loopholes the rest of us can't see. The truth is both more boring and more infuriating. The rules are public. The rules are legal. The rules are sitting in the tax code for anyone to read. The wealthy simply took the time to understand them and built their lives around them. You don't need more money, you need a better plan. Now, I want to be careful here, because I'm not telling you to become a billionaire. I'm not telling you that you can replicate the strategy of a family with $50 million when you're a 45-year-old engineer with a 6-figure salary and a mortgage. What I am telling you is that the underlying principle, the principle of shifting your income over time from the heavier earned income tax code toward the lighter capital income tax code, is available to everyone, in smaller amounts, in slower time frames, but available. The wealthy shifted faster because they had more capital to shift earlier, but the path itself is not exclusive. Every dollar you contribute to a 401k, every dollar you put in a Roth IRA, every dollar you invest in a taxable brokerage account and hold for more than a year, every dollar you invest in real estate, all of it is slowly moving you toward the same tax code the wealthy live under. Not in one step, in thousands of steps, over decades. But there are specific, concrete techniques that middle-class Americans can use to accelerate that shift. Techniques that are completely legal, fully available in the main body of the tax code, and used every single year by Americans who understand them. And almost nobody is teaching them in plain language to people in their 40s. That's what comes next. Let me give you these specific techniques. In plain language, real things you can do, starting this year, that shift you toward the better tax code without needing to be wealthy. Technique 1 is tax loss harvesting. This is something that sounds complicated but is actually simple. When you own investments in a taxable brokerage account, not a 401k, not a Roth IRA, but a regular investment account, some of those investments will go up over time, and some will go down. The wealthy have understood for decades that you can strategically sell your losing investments before the end of the year, recognize the loss on your tax return, and use that loss to offset gains from your winning investments. Even better, if your losses exceed your gains in a given year, you can use up to $3,000 of additional loss to offset your ordinary earned income. Ordinary income, the kind that's taxed at 30–35%. You're using a paper loss to reduce your most heavily taxed dollars. This matters because most middle-class Americans with investment accounts don't do this. They let their losing investments sit there, forgotten, providing no tax benefit. Meanwhile, the wealthy run tax loss harvesting every single December, automatically, systematically, often through their advisors. Same investments, same markets, same country, completely different tax outcomes. Technique 2 is asset location. This is one of the most underused strategies in American personal finance. The idea is simple. Different accounts have different tax treatments. A Roth IRA never gets taxed again. A 401k gets taxed when you withdraw. A regular brokerage account gets taxed every year on dividends and every time you sell. The wealthy understand that if you hold your highest growth investments in your Roth IRA, your dividend-paying investments in your 401k, and your tax-efficient index funds in your brokerage account, you can dramatically reduce the total taxes you pay over a lifetime. Same investments, same returns, different accounts, tens of thousands of dollars of tax savings across decades. Technique 3 is the backdoor Roth conversion, which we touched on in a previous video but deserves to be repeated here. If you earn too much to contribute directly to a Roth IRA, you can still contribute to a traditional IRA and then convert it to a Roth. The IRS explicitly allows this. The wealthy do it every year. Middle-class Americans often don't even know it's available to them. Technique 4 is what's called a mega backdoor Roth. This one is powerful for people with specific 401k plans at work. Some employer plans allow after-tax contributions to your 401k on top of the regular pre-tax limits. Those after-tax contributions can then be converted, in many cases immediately, to a Roth. This can mean contributing an additional $30,000 to $40,000 per year into a Roth environment, money that then grows tax-free for decades. Almost nobody in middle-class America uses this. Almost every high-income professional who has access to it does. Technique 5 is real estate. And here I need to be honest with you. Real estate is one of the few places where middle-class Americans can access tax strategies that look a lot like the ones the wealthy use. When you own a rental property, the tax code allows you to deduct something called depreciation, a paper expense, not a real one, that reduces your taxable income even as the property actually appreciates in value. You can own a rental property that generates positive cash flow every month and still show a paper loss on your taxes, which means you pay zero tax on the rental income, which means every dollar the property appreciates is, effectively, being earned tax-free. This is how so many ordinary Americans build quiet multi-million-dollar net worths over 20 or 30 years. One rental house, then two, then four, held for decades, depreciated every year, refinanced when equity builds up, tax advantaged at every step. Technique 6 is the health savings account, which we also touched on previously. Triple tax advantage. No other account in the code offers this. The wealthy max it out every year. Most middle-class Americans don't even use it as an investment vehicle. If you fix this, everything changes. You don't need more money. You need a better plan. Now, I want to say something important. I'm not telling you to use all 6 of these strategies. That's not realistic for most people. What I am telling you is that even using 1 or 2 of them consistently over 20 years can save you tens of thousands of dollars, maybe hundreds of thousands, same income, same effort, just different rules, understood and applied with intention. But to really use these techniques well, you need to understand something about how the wealthy think about taxes that's fundamentally different from how the middle class thinks about taxes. And it's this mental shift, more than any specific technique, that creates the biggest long-term difference. Here's the mental shift, and I want you to really sit with this, because once you internalize it, you start seeing the entire financial world through different eyes. Most middle-class Americans think about taxes as something that happens to them. Taxes arrive in April. You fill out a form. You either owe money or get a refund. Beyond that, taxes feel like weather, something beyond your control, something you react to, not something you design. The wealthy think about taxes completely differently. They think about taxes as a line item on every single decision they make throughout the year. Every investment purchase, every sale, every job move, every property transaction, every retirement contribution, every charitable donation. At every one of those moments, they ask a question the middle class rarely asks. What are the tax implications of this specific choice? And is there a different way to structure this that would result in a lower tax outcome over time? This is the fundamental difference. The middle class treats taxes as a once-a-year event. The wealthy treat taxes as a year-round discipline. And over 20 years of financial decisions, this difference compounds into enormous wealth gaps between people who started at similar places. Let me give you a concrete example. 2 45-year-olds, both earn $200,000 a year, both invest consistently, both want to retire comfortably at 67. Person A treats taxes passively. She contributes to her 401k because her employer offers a match. She takes the standard deduction every year. She files her taxes in April using whatever tax software her friend recommended. She never thinks about it beyond that. Person B treats taxes actively. He maxes out his 401k, contributes to a Roth IRA through the backdoor method, invests in a taxable brokerage account where he tax loss harvests every December, uses a health savings account as a long-term investment vehicle, and bought a small rental property in his late 40s to access depreciation benefits. He meets with a good accountant once a year, not to file his taxes, but to plan the coming year strategically. Both people earn the same income for 22 years. Both invest similar percentages of their income. But person B quietly saves on average $15,000 to $20,000 a year in taxes by making more strategic decisions throughout the year. Over 22 years, that's $330,000 to $440,000 of additional investable money invested in the markets, compounding over the same time frame. That becomes somewhere between $800,000 and $1,200,000 of additional retirement wealth. Same salary, same work ethic, same market returns, different tax discipline, $1 million of difference at retirement. This is where most people get it wrong. They assume tax strategy requires being rich. They assume you need a team of accountants, a law firm, and complex offshore structures. You don't. You need attention, curiosity, a willingness to spend a few hours a year learning how the tax code actually works, and the discipline to apply what you learn to every significant financial decision you make. Most of what I've described in this video is accessible to any American earning a middle class to upper middle class income. None of it requires being in the top 1%. None of it requires offshore accounts or shell companies or secret accountants. It requires knowing the rules and using them deliberately. And here's the part that's quietly beautiful. Every technique I've described works better the earlier you start. Tax loss harvesting compounds, Roth conversions compound, asset location compounds, real estate depreciation compounds across decades of ownership. The longer you practice these strategies, the more dramatically they separate you from peers who earn the same amount, but never learn the rules. You don't need more money, you need a better plan. Now there's one more category of tax strategy I want to touch on because it's the one most people completely ignore, and it might be the most generous part of the American tax code to the patient individual. It's charitable giving done strategically. I know, this sounds boring, but stay with me, because this is another area where the wealthy have been quietly building tax advantages while the middle class writes small checks and takes the standard deduction. When you donate appreciated stock to charity, stock you bought years ago that's now worth significantly more, you get to deduct the full current value of the stock from your taxable income, but you never pay capital gains tax on the appreciation because you didn't sell the stock, you donated it. The charity gets the full value. You get the full deduction. When you donate appreciated stock to charity, stock you bought years ago that's now worth significantly more, you get to deduct the full current value of the stock from your taxable income. But you never pay capital gains tax on the appreciation. Because you didn't sell the stock, you donated it. The charity gets the full value. You get the full deduction. The gain escapes taxation entirely. There are also donor-advised funds, charitable remainder trusts, qualified charitable distributions from IRAs, and other structures that allow you to give generously while simultaneously reducing your lifetime tax burden. The wealthy use these aggressively. The middle class usually doesn't know they exist. But here's the biggest realization waiting for you in this video, and it's coming next. Here's the realization. And I want you to really hear this because it might change the way you think about the next 20 years of your financial life. The tax code is not your enemy. It's actually your roadmap. Most middle-class Americans see the tax code as this hostile, unfair, punishing thing that exists to take money from them. And when you're living under only the earned income part of the code, that's exactly what it feels like. Every raise gets smaller after taxes. Every bonus disappears faster than you expected. Every promotion pushes you into a higher bracket. It genuinely feels like the system is designed to keep you from getting ahead. But here's what almost nobody realizes. The tax code is telling you, in remarkably clear terms, exactly what the government wants you to do with your money. And it's willing to reduce your taxes, sometimes dramatically, if you do those things. The government wants you to save for retirement. So it gives you 401ks, IRAs, Roth IRAs, tax benefits for saving. The government wants you to own investments long term. So it taxes long-term capital gains at lower rates than ordinary income. Tax benefits for patients. The government wants you to own rental real estate. So it gives you depreciation, mortgage interest deductions, and Section 1031 exchanges. Tax benefits for ownership. The government wants you to start businesses, so it gives you Section 199A deductions, pass-through entity benefits, and countless small business deductions. Tax benefits for entrepreneurship. The government wants you to save for health care, so it gives you HSAs with triple tax advantages. Tax benefits for responsibility. The government wants you to give to charity, so it gives you deductions for donations, appreciated stock gifts, and complex charitable structures. Tax benefits for generosity. Every one of these benefits is there because the government has decided through legislation that it wants to encourage these specific behaviors, and it's willing to give up some tax revenue to make those behaviors more attractive. The wealthy have been reading the tax code as a menu of incentives for generations. They look at it and ask, what is the government offering me to do with my money, and which of those things fit my life? The middle class reads the tax code, when they read it at all, as a list of obligations, a list of things being taken, not a list of opportunities being offered. If you make only one shift after this video, let it be this one. Start reading the tax code as a menu, not as a wall. Every time you encounter a tax concept you don't fully understand, ask yourself, is the government incentivizing something here? And if so, is it something that would make sense for my life? This mental shift alone, applied consistently over 20 years, will change your financial outcomes more than any specific technique I described earlier. Now let me bring this all together, because we've covered an enormous amount of ground. 2 tax codes, borrowed money as a third category, 6 specific techniques, the mental shift, charitable giving strategically, and the reframe of the tax code as a roadmap. And I want to give you one final piece before we close, a piece that makes everything else possible. You need a good accountant, not a chain tax preparer, not tax software, a real, credentialed human being who understands strategy, not just compliance. Someone you can call in October and say, here are my financial plans for this year. What am I missing? What should I structure differently? What would the wealthy do in my situation? A good accountant costs somewhere between $1,000 and $3,000 a year for a middle-class American family. And that investment, over 20 years, typically returns somewhere between 50 and 200 times what you paid. It's probably the single best dollar-for-dollar return on any professional service you'll ever buy. The wealthy have been working with accountants like this for generations. The middle class, for the most part, hasn't. They treat tax preparation as a commodity. They shop for the cheapest option, and they pay silently hundreds of thousands of dollars in lifetime taxes they could have legally avoided because they never worked with someone qualified to show them the map. If you fix this, everything changes. You don't need more money. You need a better plan. Because the biggest mistake most middle-class Americans make with taxes isn't that they pay too much. It's that they think they have to pay too much. They accept the first tax code as if it's the only one. They assume the system is rigged against them, shrug, and stop looking for ways around it. Meanwhile, the second tax code, the tax code for owners, investors, planners, and patient builders, is sitting right there, in plain English, waiting to be used by anyone who takes the time to read it. And that's the real opportunity hiding inside this video. It's not about avoiding taxes. It's about understanding that the game has two sets of rules and deciding, starting tonight, which set of rules you want to play under for the rest of your life. Before I close this out, and trust me, there's one more piece that matters, I want to pause for a moment. If you've made it this far into the video with me, if you've sat through tax codes and capital gains and borrowed money and depreciation without clicking away, if you're still here and still thinking about how all of this applies to your actual life, I want to invite you to subscribe to this channel and walk with us every single day. This is the kind of conversation we have here. Not sensational, not political, just honest mechanics, just the rules of the game laid out in plain language for people who are old enough to want the truth. And I want to say something directly. Talking about wealth and taxes in America can feel uncomfortable. There's a cultural pressure sometimes to pretend you don't notice the difference between how labor is taxed and how capital is taxed. To shrug and say, that's just how it is. But you're in your 40s now. You've been paying taxes for 20 years. You've earned the right to look at the system honestly, to ask how it really works, and to decide consciously whether you're going to keep playing only under the rules you've been assigned, or whether you're going to start learning the rules that everyone else has been using the whole time. You're not trying to cheat anyone. You're not trying to game the system. You're trying to participate in the system the way it was actually designed to be participated in. And nothing about that is wrong. Now let me give you the last piece, the piece that pulls it all together. The wealthiest Americans don't just use tax strategies. They structure their entire financial life around them. And that structural approach is the real secret. Not any single technique, the coherent integration of all of them. Here's what I mean. When a wealthy family thinks about their finances, they don't think in separate buckets. They don't think, I have a 401k, and separately I have a brokerage account, and separately I have a rental property. They think about everything as one integrated system. Every dollar that comes in has a planned path. Some dollars get directed into Roth vehicles because tax-free growth serves specific long-term goals. Some dollars get directed into taxable accounts because flexibility matters for other goals. Some dollars get directed into real estate for depreciation benefits and leverage. Some dollars get directed into charitable vehicles for both tax efficiency and legacy planning. The whole thing works together. The middle-class approach, by contrast, is usually siloed. A 401k at work because the employer offered it. Maybe a Roth IRA because someone mentioned it once. Maybe a savings account at the bank because that's where the paycheck lands. There's no master plan. There's no integrated strategy. Each account exists in isolation, doing whatever it does without the pieces talking to each other. If I could give you one single action item to take away from this video, it would be this. Spend a Saturday afternoon sometime in the next month sitting down with every account you own, all of them. Your checking account, your savings account, your 401k, your IRAs, your brokerage accounts, your HSA, your home equity. Write them all down on a single sheet of paper. Look at the whole thing at once. Ask yourself, is each of these accounts doing what it should be doing for where I am in my life? Is the right kind of money in the right kind of account? Am I missing any major tax advantages by having things in the wrong places? That one exercise done once is often worth more than 1,000 hours of reading financial articles. Because most of the money being left on the table in middle-class America isn't being lost to bad investment choices. It's being lost to disorganization, to accounts set up 15 years ago and never revisited, to tax benefits that are sitting there unused because nobody connected the dots. If you fix this, everything changes. You don't need more money. You need a better plan. And a better plan starts with seeing your financial life as an integrated whole, not as a scattered collection of accounts. The wealthy have been doing this forever. The middle class, with the right information and a few hours of patient attention, can absolutely do the same thing. The tools are not exclusive. The tax code is not private. The strategies are not hidden. They're sitting in plain sight, waiting for someone to take the time to read them, understand them, and apply them. You've earned your income. You've paid your taxes. You've played by the rules you were given. Now it's time to learn the rules you were never shown. There's a scene I want you to carry with you after this video ends. Picture an accountant's office. A quiet one. Wood panels on the walls, a framed law degree, a desk stacked with folders. It's the second week of October. Outside, the leaves are turning. Inside, the accountant is meeting with a client, a middle-class professional in her late 50s. She's been coming here once a year for the last 10 years, not to file her taxes. That's a separate visit in April. This is the strategy meeting, the one where they look at the coming year and map the moves ahead. She sits down. The accountant slides a folder across the desk. They go through it together. The Roth conversion they planned last year worked exactly as designed. The rental property is 3 years into its depreciation schedule, and the tax benefit is significant. The HSA, now invested for over a decade, has crossed $200,000. They talk about tax loss harvesting targets for December. They discuss whether this is the right year to donate appreciated stock. They plan the timing of her next charitable gift, the timing of her retirement account withdrawals, the structure of her eventual exit from full-time work. 30 minutes later, she walks out of that office with a clear plan, and that plan, executed quietly over the next 12 months, will save her somewhere between $12,000 and $20,000 in taxes that would otherwise have been paid. Now picture a different American of the same age, same income, same career. She files her taxes every April using tax software. She's never worked with a professional. She has a 401k because her employer offered one, but she's never thought through its relationship with anything else she owns. She takes the standard deduction every year without questioning whether it's the best choice. In her mind, taxes are a thing that happens, not a thing she does. Both of these women have worked equally hard. Both have earned similar amounts over their lifetimes. But one of them, after 20 years of these small differences stacked on top of each other, will retire with several $100,000 more than the other. Not because she earned more, not because she was luckier, not because she had any special advantage. She just decided at some point in her 40s to treat taxes as a strategy instead of an event. That's the whole difference. That's the entire thing this video has been building toward. The gap between the two tax codes is not as insurmountable as it looks from the outside. It's a gap that closes, dollar by dollar, decision by decision, every time a middle-class American takes the time to learn the rules that the wealthy have been using the whole time. You are not behind. If you're in your 40s tonight, you have exactly the window you need. Not too late, not too early, right in the sweet spot where deliberate tax planning can reshape the rest of your financial life. The next 20 years are not going to save themselves. The tax advantages available to you today are not going to sit there forever, waiting politely. They're available now. They expire in some cases. They change with legislation in other cases. The version of the tax code you see in front of you today is the one to use today. Start with one thing. Just one. Whatever technique landed hardest for you during this video. The backdoor Roth, tax loss harvesting in December, looking into an HSA, finding an accountant who actually does strategy. Whatever it is, pick it, commit to it, and start this week. Because the Americans who quietly retire wealthy are not the ones who earned more than everyone else. They're the ones who understood, earlier than everyone else, that wealth in America is not built in the earning, it's built in the keeping. Now, before you go, let me ask you for 3 things. First, if anything in this video shifted something in you, subscribe to this channel. Walk with us. The next video in this series is going to be about what happens to everything you own when you die, and why 2/3 of Americans over 50 have no plan for it, with consequences that destroy families long after the funerals are over. You don't want to miss that one. Second, share this video with 5 people, 5 coworkers, 5 friends, 5 family members, people in their 40s and 50s who have never been shown that the tax code has 2 sets of rules. You might be the reason, 20 years from now, that one of them has a retirement they didn't think was possible. And third, leave me a comment, a real one. Tell me which technique surprised you most. Tell me which one you've been using without realizing it. Tell me what you want me to dig into next. Every deep video we make starts with someone asking the right question. Take care of yourself. Take care of the people counting on you. And remember, wealth is not built in what you earn. It's built in what you keep. And what you keep is mostly decided by how well you understand the rules.